Right, I'm here in London with Lee Robinson, the founder of Altana Wealth. Lee, welcome. Good to have you here.
Thank you.
There's a ton of stuff I want to talk to you about today.
Great.
So perhaps we could kick things off with you, just give a little bit about your background, and then we'll get into a whole list of questions I've got for you.
Okay. Well, my background is always been in finance, trading. I started off in derivatives, Paribas, in equities, and then fixed income derivatives at Bankers Trust. I've made a lot of good friends. And then I went to credit derivatives, and then I went back to my original love, which was equities, working for the hedge fund, Paul Tudor Jones, doing event-driven. I then spun out, set up my own hedge fund, Trafalgar Asset Managers, grew that to 2 to 3 billion over 2001, 2010, sold a stake in that to Goldman Sachs Petershill. And I think one of our claims to fame, getting 5 Euro hedge nominations in 2008, winning 2 of them, getting the whole subprime crisis right, getting the markets right that year. We were long vol, we were long Volkswagen, short the prefs, we were short Iceland. We got a lot of things right, Bear Stearns as well. And then when I sort of got through it all, and I suddenly realized that my knowledge of economics and history wasn't good enough. And I always keep saying to people, to be good at any profession, the first thing you need to do is read about it.
Yeah.
That's the only thing you need to do, unless it's something brand new. If I was setting up a plumbing business tomorrow, I'd go look at some books on successful plumbing businesses, And so I started doing the reading, and I came to the conclusion that really we were either going into a deep bankruptcy cycle in 08, 09, or we're going to go to a money printing cycle, and possibly the easiest solution for governments is money printing. So you look back through the history of all this and fiat currency and do the reading, and I came to the conclusion that currencies would be the key for the next decade, really. As financial repression would mean interest rates can't go up. The JGB trade, I've always felt interest rates in Japan would go up way after the currency move and way after their stock market move, be the last thing to move, and similarly elsewhere. So I set up Altana Wealth really with a view that in a world of too much debt and not enough assets, real returns for global investors will be negative over the next decade. There'll be some massive winners and some massive losers, but the median return will be less than zero, and I want to be one of the guys that's greater than zero with my own money for 10 years, 30 years, 40 years, passing on to my family or whatever I want to do with it. And therefore, I looked at a lot of the wealth management studies. I looked at the plumbing, and I looked at the back offices and middle offices, a lot of investment companies, and I thought to myself, they still haven't really learned the lessons.
Yeah.
They're still not ready they weren't ready for 02. They weren't ready for 97, and they weren't ready for 07, 08, and they don't look like they're ready for the next wave. Now, people say to me I'm bearish, but I say to people this following. If you could see what I could see in 07, 08, and what I could see now, and you did nothing about it and you were right, how bad do you feel?
Yeah.
If I'm wrong, I keep telling people that a lot of these probabilities of capital controls are 20, 25%. They're not 50%. The probabilities of the government stealing your money, like in Cyprus, are 20, 25%, not 100%. But if you don't take precautions, you're an idiot if you're right. If you take precautions and you're wrong, well, it doesn't matter. Your money's just a bit safer, and you spent a small amount protecting it.
Well, this is actually a really interesting point, because people, you're talking about taking precautions. People think when you get into this thing about someone's bullish or bearish, they think that the bears just want to sell everything. There's always ways to make money in markets. There are places you can go, and places you can either hide or find a sensible risk-adjusted return. Being bearish is sometimes just about being open to possibilities and taking precautions.
But you could be bullish. Take a very good example. You could be bullish. Let me step back. What is the difference between a professional and an amateur investor? An amateur investor buys often better than a professional investor because he doesn't have drawdowns to worry about. He can go in a panic. Right. Often an amateur can buy better. I always tell people the difference between a professional and an amateur is the ability to sell. Professionals sell better, whether it's at the top, or 5% off the top, or buying puts to take them out, whatever it happens to be. True professionals think about their exit, their pathway, and then the entry point becomes self-evident. A lot of people, amateurs, buy in and then wonder how to get out and then do a bad job and often sell too early or when they're right, or often sell too late when they're wrong. It's a difference for professionals. So a lot of the bears that I speak to come across as more intelligent to me than bulls. Not because the bears are right, the bulls are right, but I look at the bulls and a lot of them don't have an exit plan. If their exit plan is to ride this bull market by buying 10% out the money puts all the time, or buying in the money calls and riding and rolling it, Nothing wrong with that. It's a perfectly sensible strategy. If their attitude is I'm going to average in over 5 years, perfectly sensible strategy. If their attitude is I'm going to leverage it up 4 times and hope I can get out in time, it's not a sensible strategy. So then we lead on to some of the bears and some of their mistakes. So gold is the one that really annoys me. So I talk to the people who are really bearish about fiat currency, and I would be one of those people. And inevitably it comes down to a question of gold being one of the solutions. So I say to them, where's your gold? How do you hold your gold? And most of them are smart enough to hold physical gold rather than paper gold. So where do you hold your physical gold? Oh, I hold it in London, in Barclays or HSBC or whatever. I said, where do you live? I live in London. Okay. I said, you just told me you think if we go to fiat currency, we might have anarchy. Why would you have your gold in London? You know, why wouldn't you have it in Switzerland or Singapore or somewhere else? And they say, well, I want to have my gold because I want to have some gold to be able to run, to move across borders. You know, your 1933 Germany or your 1920s Russia. I want to be able to just pick it up and go. I said, well, you've got gold bars. How are you going to move those? You know, have you tried taking 10 gold bars anywhere? You know, how about gold coins? How about diamonds? You know, start thinking. So I always tell the people, if you're going to do paranoia, do it properly. So I have my gold, I can tell you now, Perth Mint in Australia. I have my gold in the Canadian Mint. I have my gold in Switzerland in a bank. I have my gold in a safe. You know, I have it in 4 locations, and I have options on paper gold, on the GLD or whatever. So I'd say to people, if you're going to do paranoia, do it properly. And the most important thing is, as we learned in 08, and a lot of people still haven't learned, is if you want to buy gold, because it's turned, or you want to move your money to another jurisdiction, the KYC, anti-money laundering documentation is 4 weeks minimum now, best of times. Can be 8. And in a crisis, it'll be 12. It'll be too late. So I say to all my clients who buy gold, I say, open an account with the Perth Mint or Royal Canadian Mint or wherever it is, put $1,000 in. Put an amount of money, it doesn't really matter. 10,000, whatever it is. But the account's then open.
Yeah.
And then if you want to buy $1 million, 10 million, 100 million, it's a 2-day transfer rather than an 8-week process. You know, if you're worried about Cyprus and exchange controls coming to your country and you want to set up an offshore bank account, don't avoid the taxation, don't avoid breaking the law, but you want to set it up, that's a 4-week process. A foundation is an 8-week process. Finding a good trustee you trust, an 8-week process. You need to do this now, and that's what I think I'm talking to clients about at the moment. Getting prepared, because the probabilities of a lot of these bad things, and the IMF has already said in October 13, we think there should be a 10% one-off wealth tax. They've already shown how they're going to do it. They're going to go straight into the bank accounts, take the money out. Now, they may take it out of every single bank account, but the probability is they won't take it out of charity bank accounts, they won't take it out of corporate bank accounts, because that kills jobs and it becomes a vicious circle. So the first wave will almost certainly be out of individual bank accounts. So anybody with money today who does not have a company in their own name with cash account today is a fool.
Right.
It doesn't mean it works, but it's one level removed barrier.
But
that's $5,000 to set up.
That's back to precautions. I mean, you deal with very wealthy families, right? This is, you deal with people who have, you know, problems a lot of people would love to have.
Absolutely.
But as a good friend of mine, Steve Diggle, said in an interview I did with him, he said, you know, it's never a good time to be poor, but now's a really bad time to be rich, because there's a group of people who need money and have taxing authority, and there's a group of people who have money and have no means to combat those sort of moves. So what are you talking to your clients about? What are specific situations, advice you're giving them in terms of how to deal with this?
So what am I telling my clients? You know, one of the things we talked about is foundations. And one of the things I find very odd, if you give me your money, you don't actually give me your money to manage Altana Wealth. You give it to a third party in the middle who's a fiduciary who does the checks. It could be an administrator, but it could be a trustee. Who checks that person on your behalf? Yeah. A lot of times they're in small islands, reputable firms, but who's to say the chap who's doing it hasn't just gone for a divorce and gone down a drug habit and decides to start skimming out the account? I mean, who's to say that doesn't happen? Who's to say you're a family of 5 and you've denoted one of the siblings to be in charge of signing power? Who's to say that he doesn't start taking the money out? So one of the things I always say to clients is, what smaller asset managers can do is, I will notify you when I wire the money back to your intermediary. I won't stop him because you've told me he does, but I will tell you, and it'll give you 2, 7, 30 days, whatever you say, to stop or do something about it. Simple checks like that I try to clients, but I say to people, look at foundations. You can now be on the board yourself of a foundation rather than putting a trustee in the middle and still have the same tax benefits. You still have to have a trustee on there, fiduciary like Jersey. It has to be a financial regulated entity in Jersey. But you can also be on there. So I'm finding a lot of, particularly Eastern Europe, where trusts are not recognized, and Southern Europe, they're rolling their whole business into a foundation. Property business, whatever. I have a charitable foundation that I've set up that way, where I have de facto control on which people would give the money to, rather than a trustee, so I have control. So I'm telling people that. I am definitely telling people to set money up in multiple locations. Gold, cash bank accounts, trading accounts, in at least 3 locations. And when I say 3 locations, I mean 3 intercontinental locations. I don't mean Switzerland, Austria, and Germany. I mean Switzerland, Canada, Australia, or Panama, or wherever they want to go to, whatever their choice is, but not somewhere. People forget, in all types of repression and society, it's often easier to get yourself physically out. You bribe the border guard, or you bribe the local police. You can get yourself physically out of a country under repression in all types of. Getting your money out is often 10 times harder.
Yeah, it needs to be out already.
I mean, people forget, from 1945 till 1980, we had capital controls in England. We had capital controls in France till the best part of 84. You still now have to tell the bank if you move more than $10,000 for whatever reason. It's quite funny. One of my bankers said to me, if you come in and tell us that you're taking $10,000 out for prostitution because you're taking clients out, we'll okay that. But if you're moving it to somebody we've never heard of for a payment, we won't pay it. It's like, what kind of world do we live in? This is the case. So clients, fortunately, a lot of these very wealthy clients have made their money, not like finance, they've made their money intergenerationally, and they have lived through capital controls. They've been in South Africa, they've been in Asia under repressive, they've been in Eastern Europe under some of the worst regimes. And then we look at Eastern Europe and we say, what happened in Eastern Europe? What got taken? You got houses taken, you got your lives taken, whatever. One thing they did take was small companies. So they nationalized everything under communism. And so they took all the big companies, the steelworks, the railworks, but the smaller companies, where there were 25 to 200 people, where there were maybe 3 key people who made the decisions, they took them, and guess what? Well, within a week, they didn't work, and you got people on the streets and complaining and what have you. So they gave all those companies back. So one of the things I learned about reading history is that owning cash flow positive, smaller companies, private companies, is something shown. So I'm definitely working with I have a group of 18 entrepreneurs where we share ideas that we're investing in, and we're looking for really the sub $25 million capital companies, because you start getting above that, it's just ridiculously competitive. Retirement sales, development capitals, and it's very hard to find.
To me, there's a big lesson here for people watching this, and that is, when you talk to, say, some of the wealthiest families in Europe and around the world, some of the smartest people you're going to find, and these conversations that you're having, to a lot of people, they tune out. They go, oh God, this stuff can't happen. But the smartest and the wealthiest people think these are very real possibilities, and they're taking action.
Well, the probabilities just changed from 1% to 25, but they're also historic. But I would step back even further, and I would tell people the following story, and it's not a very nice story. But the story is as follows, and not politically correct story. But why are we where we are today? And the reason we are where we are today is because of the social welfare state. And it has compounded up from 1945. And every government has promised more and more to stay in power. And now the maths isn't working. You can't work for 25 to 55, paying in a third of your, or a quarter of your salary, and then expect to live on the same amount from 55 to 85. It doesn't work. I mean, you can't have that society. So the welfare state's unaffordable. It cannot be inflated away. Everyone says to me, we inflate away our debts. Look what happened to Britain post-World War II. Well, that's a load of, it's just rubbish, right? Okay? Because the 100 trillion or so of American debt, that's Medicare and pension related, that's implicitly inflation linked. You have to pay for drugs. You have to pay for someone to put food in your mouth. You have to pay for someone to dress you in the morning, whatever it happens to be, and all these different things to happen when you get older. And that's been inflation linked. And so we've got 100 trillion compounding at 2 to 4% a year. And we've got the 20 trillion on balance sheet that gets compounding, whatever the word is, amortizing down by 2 to 4% a year by inflation. So these idiots in power think that they're getting away with the debt, but every cycle, they're pushing it up. And you look at Germany, UK, USA, all of their off-balance sheet numbers are 3 or 4 times Spain and Greece's, because these countries had so much anarchy in between 1945 and the 70s, didn't really have the social welfare state. So all these countries are bankrupt forward. Somewhere between 2000 and today and 2030, they all start becoming bankrupt, with the Japan problems coming everywhere. So social welfare state is there. Now, these politicians know this. They're not that stupid.
Right.
So the US balance sheet, as I was saying, has gone up by $1 trillion last year rather than 580. Why? Because 420 billion has come due from the 25 years worth of plus of people becoming retirees and needing help and service. And you've seen the price of drugs and healthcare over the last 10 years. Inflation's been double digit. So this idea we inflate away debt's not. So what are we going to happen? Very obviously, the government's going to say to us tomorrow morning, we've made loads of mistakes, we're quitting, we're off. That's what they're going to say. It's our fault, we're off, bring a new bunch of people involved. No, they're not going to do that. They're going to stay in power, and they're going to stay in power as long as possible. That's in their DNA. They are going to hang on. And therefore, they need to find money. And they therefore are going to bring in anti-money laundering controls, KYC rules, money wiring instructions, so they know where the money is. And then they're going to go and take some. And by the way, it's not going to be enough. They're going to take some more.
Right.
And that money's going to keep running, and it's still not going to be enough. Because the more you take, the more you push the problem down the road, the more you can keep running up those debts. So it won't happen. So ultimately, we must have a default either on our obligations to our pensioners, and our old and our weak and our sick, by giving them worse drugs, moving the pension age up, and I have to say probably a default on debts. We'll have to have a reset. And the only way you can really do a reset with the wealthy who have to put capital in your country is, I think you have to change the labour laws, you have to change some of the red tape. You need to say to people, we're changing, but we're making our country still attractive. So then you go to the labour force and say, look, we're having to give you less standard of living, but we are taking money from the rich. There's going to have to be some sort of grand bargain at some point. And we're seeing it now. The inequality arguments, it's all being geared up to attack the rich. And, it's not the rich. It's 250,000 or more in the US. These are not numbers that are the rich. No. If you've got 10 million and you've got an income of 1% on that money, of 100,000, you will not be able to pay some of your taxes and mansion taxes coming in. So, there's going to be a lot of change. So I'm saying a lot of wealthy families, there is change. Social welfare is not going away. You need to be prepared for the fact that they're going to come out. And I talk to families who have got hundreds of millions in art, in free ports, or in museums where they're insured, because you know what? They can move those in 24 hours. They have gold, they have diamonds, they have some of this movable assets. The one that you've got to be careful of is property. Yes. Because it's immovable and it's being taxed higher and higher in every country.
Well, it's interesting, Larry Fink coming out yesterday. We're sitting here talking on a Wednesday, and yesterday a big article, Larry Fink of BlackRock saying, forget gold. The real way to protect yourself is to own high-value real estate in Vancouver and New York and London.
Well, Larry has his views. I mean, Larry obviously has to toe an establishment line as well. Sure. I mean, the nice thing is I can be controversial because I don't have to worry about the establishment line. We talked about earlier about it's amazing that certain people running certain global currency fixed income brokerage houses don't go to jail, but some guy in Surbiton has been charged for bringing down the S&P.
The cash,
I mean, there is a society at the moment where corruption exists, laws exist for certain people, not for others, which maybe brings us on to how we would change things. But
yeah, well, let's talk about that, because I think through doing these interviews for Real Vision, I get a very good sense that there's an incredible amount that's wrong in the world today, and we spend a lot of time talking about the problems and how bad they are, how they manifest themselves. What do you see any obvious solutions to any of these problems that you think are feasible and actionable?
Well, feasible and actionable is a different matter, but I think there is a big stumbling block in that the politicians who got us to where we are today, a lot of them are seeing socialism fail in the same way communism failed, simply because it ran out of money. Yeah. And the laws of economics and capital destroyed communism in the end, not ideology. And the laws of capital and communism are capital and economics is destroying socialism as we watch. It's not affordable. We've promised too much to too many from too few. And if you look at history, where do we want to be is what I would answer this question. Where do we want to be? We want to be in a society somewhat similar to the Swiss or the old Venetian society, where we have much smaller government. Bigger government means they can set more laws and take more of your freedom away. We are, without doubt, sleepwalking towards tyranny. We have put laws in place, little by little. 24-day detention laws, people in Guantanamo Bay without trial, in supposed the free land of the free, banking laws where we can't move our money around, places in Europe you can't move cash more than 3,000 euros. We have got jobs for life in different places. We've got Brussels having a closed session to agree a 2.5 billion excess to the budget. Excess, not a budget of 2.5 billion, behind closed doors. We've got the US and the Europe not having signed out on our audit. No publicity, no transparency. So where do we want to be? We want to be a society where corruption is less, where the people have more control, where the government acts for the people, not for themselves. So one of the first things we have to move back to is one term only in power. We cannot have a situation where the President of the United States is in power for 5 years, he spends 2 out of 5 years re-campaigning to get re-elected. He needs to come in, work as hard as possible for 5 years. 4 years is it? 4 years. 4 years. 4 years. So it's 1.5 out of 4.
Yeah.
You know, France has gone from 7 years to 5 now, you know, and they can have 2 terms rather than 1. One term only, the guy or girl comes in, does the best job they can, and they're out. And they also means they're setting rules that will affect them for the rest of their lives, rather than they're doing there for 15, 20 years. And if you're in opposition, maybe you have 2 terms, but 1 term only. We must have it that you cannot set laws unless they are for the 100% of the population. We cannot have people in the EU setting taxation laws in countries and VAT when they don't pay tax themselves.
No taxes, yeah.
I mean, there's a conflict of interest. And I would go, you know, everybody has to abide the law and everybody has to respect it. It has to be transparency. We have to devolve power and actually get rid of the central banks, but we need to absolutely reduce the power of the central banks. And finally, one of the things I think we haven't talked about is we talked about responsibility. In almost every area of society now, you have to have qualifications and tests to be able to do your job, to be able to drive, to be fit to be able to drive at 65 and above. You have a 1 in 3 chance of a mental illness above 75. Yet, Alan Greenspan was in charge of the Fed between the ages of 70 and 80 plus. And regardless whether you like the man or dislike the man, he made enormous errors. Now, is that because he's stupid? Is that because he's egotistical? Is that because maybe he wasn't well, wasn't fit to do the job? I think, what if we've got somebody worse? We've got somebody in charge of armed forces, naval aircrafts, sending men to their deaths, perhaps got some sort of mental illness. We need to have physical, mental tests for anybody who's in power every 2 years. Power of responsibility. Anyone who has responsibility for more than 1,000 people. That could be in big companies and everything. We need to have that. And we need to have that publicly done. We now have potentially the next President of the United States being 73 at the end of her first term and 78, 77 at the end of her second term. It's inconceivable that a role today as important as that, when we're retiring people at 55, retiring people in many countries 65, you know, traveling under that much pressure, that we can do it.
Well, the stress for these people is ratcheting
enormous,
up every
enormous.
day.
And there is a link between mental illness and high stress, short sleep jobs. I mean, there is a link as well. We need to have these people tested regularly. And, you know, I keep saying it, you know, why are they setting laws which, you know, for example, why is it that every job in the UK and France and Germany, every Western world job, you have to have some educational qualification to do it? But to be a politician, you don't even have to know the basic rudiments of law. Yeah. We should have, like the coaching badges. Unless you pass them, you can't actually even stand. You know, we should have, do you know anything about history, economics, legal process, justice? No, sir, I don't. Okay, you can't stand.
Well, I do wonder about this, because you've got guys on banking committees, finance committees, who know nothing about economics, let alone history. They don't understand economics, let alone have any reference points from history. So we've spoken about a lot of things that are wrong, some potential things that we could change to do that. You've spoken about how you've been talking to your clients and what. Are there any specific ideas that you've been recommending to people that they can actually trade in or put positions on?
Absolutely. It's funny, someone came to see me the other day and who had never met me before, and he said, I checked with a friend who you are, just to make sure you're who you are. He said, oh, he's always bearish, they said to him, right? They said, oh, he's always bearish. And I laughed at that, and I thought, well, if I hadn't been bearish, I wouldn't have been long the dollar the last 12 months, and long gold. Gold's been the best performing currency over the last 12 months. And in global currency terms, gold was slightly up year on year, 1%, and dollar was obviously superstar, and everything else was rubbish. So I think, regardless of all the pessimism, this is without doubt the most exciting period of innovation in my lifetime, and certainly maybe in 100 years. What happened in 98, 99, 2000, very exciting, internet. But it was really just the starting point. That processing power has led to DNA genome analysis. We've got peer-to-peer lending. We've got Bitcoin, which uses computer power that's never been seen before. More computer power that's ever been seen before in the last year was in Bitcoin. We've got technology in our applications on our mobile phone that it weren't even thought about in 99. So we live in a very, very exciting, disruptive technology time. We're seeing massive change in companies. I'm seeing companies embracing that change. In fact, I'm meeting a company today we're going to talk about disruptive technology. I've seen companies got their head in the sands about it. And so there's a lot of very exciting things going on. A lot of small companies doing exciting things, a lot of big companies doing exciting things. And then, so that's the first thing I'd say. I think I'm very bullish on a lot of what the change is going on. I think one of the most exciting things that no one is talking about is Google Translation, or translation itself, automatic translation. Think about it. You cannot do most sophisticated jobs, outsource them to Poland or Mexico or whatever, for the simple reason you need to be able to talk to them in German or French or English or something that in really good terms. You need even just things like, I want to change the color, I want to change the brightness, I'm editing this video now, I want you to change the sound on this, and it's complicated. You've now got voice recognition that does translation. That is going to be a job destroyer in the West and a job enhancer in emerging markets. It's going to be one of the most massive changes to Western society we've ever seen. It's fantastic out there. So looking for opportunities there, looking for opportunities in 3D printing. Who's supplying the chemicals? Who's making money? Who's really going to make the money on the backbone of that? Not necessarily 3D printing or some of the other companies, some of the people in the background, the picks and shovels. And then in capital markets, I think there's some amazingly interesting things. I think Ukraine debt, Greek debt.
See, a lot of people just started shivering while watching this.
Fantastic risk rewards. I'm a risk reward guy. I'm actually not a bear or a bull. I'm a risk reward guy. I'm a guy who'll make a 10-to-1 return, or I might make a 10% return on a 2% downside, or I might make a 10-to-1 return with 100% downside.
So what about Ukraine,
risk reward?
Ukraine bonds?
Well, I think Ukraine is fantastically interesting. I think you're talking about a country that NATO and the West has spent an enormous amount of time and money moving its chess pieces to take land. You're talking about China bidding for 7% of the agricultural land last year, and it's not clear that's gone through, by the way, since the disruption. Coincidence? 17.5 billion IMF wants to put in. They're talking about restructuring just 20 billion of debt. They're talking about doing haircuts on 20 billion debt by June. Debt is trading at 40 cents on the dollar, so about 8 billion. There's some of those others. Now, the IMF needs to get this done while it's in ceasefire. It's got a clock ticking. The bonds are paying 7%. They're 2024 anyway, so if they extend them to 2034 to 3% bonds or some such, they're not going to be that different in present value. You've got Russia, of course, in the background, and let's face it, Russia takes over Ukraine. Well, that's not so bad either. You've got pipelines going through it. It is a strategic asset. It's not Ireland. It's not Portugal. This is strategic NATO asset. So I think the bondholders are a very strong hand. They have the clock on their side. And I think the downside, if you think Greece traded at 20 cents in default with 250% debt to GDP, a country with, let's say, 75 to 125 in default, you're getting in at 20 cents, you're getting at 20% GDP. It's probably going to trade above that. So on the default, maybe trades at 30. It's trading in the low 40s. On a haircut of 40%, 30%, 60, 70, no one's going to take a haircut at 50 or 60. They're just going to play the bluff. They're going to say, well, just go to bankruptcy. There's no point. That's where we are. So I think Ukraine's very interesting, and I think the one-year bonds and the Exim UK are interesting, a bit pricey. I think Greece, everyone's missing the point on Greece. Everyone's missing the key point on Greece, except for Merkel. And if you read Madame Merkel at the end of March, and she'll say almost what I've been saying. Forget about the money. Money's not important. The money that's owed the IMF, money that's owed by the ECB, it's not their money. They'll get off the taxpayer. Greece is where NATO refuels, it's where it sets off its aircraft carriers, it's where it keeps its eye on Turkey, it's where it deals with the Middle East. It's not that far from Ukraine. So at any normal time, NATO would never allow Greece to go to anarchy, which is what drachma will cause, anarchy. At this particular point, with Ukraine very hot, Middle East with Saudi and Iran are very hot, and the US trying to get its grip in the world, Obama looking at his legacy, there is 90% certainty that NATO will not allow anarchy in Greece. And that is a key point. Anarchy is not going to be allowed. If that means pushing the debt out 10 years, restructuring, some sort of headline haircut but with some nominal growth catch-up that saves face, that's what will happen.
So why the dance? Why are we going through this whole thing? Because they're pushing it very close to the...
Because you have to have a dance.
I know,
because the Greeks are not going to come away with very much. The first few meetings, they've come away with nothing, really. And the Germans have got to go back to their people and sell them on giving more money to the Greeks. So they've got to go back. So nobody can go back a week after the Greeks come to power and give them what they wanted. For another reason, for Podemos coming through in Spain, the elections are in May 25th. It would be very nice if the Greek situation was resolved after that. The fact that Tsipras went to see Osborne in the first few days was odd, if you didn't see it in the context of the fact that he's a NATO partner running an election for May the 6th. It will definitely happen after May the 6th. So there's a lot of it has to be about timing with other governments, and a lot of it is about the fact we've got to beat our chest, beat your chest. We've got to beat your chest because the Greeks will have to go back to their people and grovel and say, I'm afraid to say, we only got 1 out of 10 or 2 out of 10 of the things we want, and we've got to give these labour law changes. We've got to do this, and the alternative is anarchy. And so both sides have got a safe face. It's always going to be 11th hour. And we've seen it with the Europeans in 2011-12. It's not 1 hour to midnight, it's 1 minute past midnight. The statement comes out with 8 lines saying we've agreed to this. And we'll get exactly the same thing in June, I'm sure of it, or a little bit later. So some of it is realpolitik, and they're going to see Russia. Do you think the Greeks went to see Russia without German approval? I doubt it very much. That was all part of the show, and it is all part of the show. They got to look bad. And Merkel said it at the end of March. Read what she said after that meeting. She said, Greece is an ally. Greece is an ally. It's been an ally for many, many years. It is our bulwark in the Balkans. She said it. She's changed the narrative in March. She can't go in April and say we've done a deal. She's going to keep that narrative running for 8 weeks and say, it's not a lot of money for German people compared to the threat of Russia coming in. And it's going to be that story. So I think Greece, again, the 42s are now at 42. The 19s are in the 60s, having been par. In drachma scenario, they are going to 10 cents. Don't get me wrong. They are very, very much going to get killed. But the PSI bonds have been restructured and probably won't be restructured in this phase. Any sort of solution of any sort, those bonds are up 20 or 30 points. And I think the probabilities, unfortunately, they're not 50-50. And it's pricing in 50% chance of going to 10, 50% chance of going to 70. I think the probabilities. NATO has just spent a lot of time building up Eastern Europe and it's not letting it go. So I like that. The area I think is very interesting, I literally just bought my first stocks yesterday, so I'm probably too early, is dry shipping. And dry shipping is, as you know, Baltic Dry has come down from at a number that doesn't make any sense, 12,000 to 580. But we will be shipping dry bulk around the world, hopefully in 3 years' time and in 30 years' time. And there will be ships doing that. And the listed companies have just done their first merger. You've just seen Knightsbridge merge with Golden Ocean. You've just seen the second one announced. The stocks are all down 80 to 90%. 35 Capesizes have been scrapped this year. Only 24 were scrapped the whole of 14. So we're on a massively bigger run rate. New orders are obviously falling off the cliff. There's no new shipping coming through. So looking forward a year, and plus oil is a lot lower. Labour costs in local currency terms are a lot lower. So there are benefits to these companies. So I think the dry shipping listed companies are interesting. I don't have any expertise in the private sector and the larger size. If you're bullish and think the global economy is going up, even better. But I think dry shipping is very interesting. And I think commodities nearly got to the point in oil. I still think we'll see $30 a barrel WTI this year, but I think it will come to a point where we have capitulation, a really big sell-off, and I think oil, longer term, the whole game plan here is to bankrupt the oil fracking companies, for them to change hands to stronger hands, and then push the price back up with a stronger cartel. So I see the cartel being much stronger in 2 years' time, and therefore implicitly a lot higher oil prices. So actually I think there's a lot of very interesting things out there. And just talking about the stock markets, we've had some of the weirdest things in the world happen in my career in the last 4 or 5 months, last 3 months. I saw silver move. Silver as a currency has been used for 6,000 years. Mm-hmm. I saw silver move in one day from 16 to 14 to 16. That's a 25% round trip in one of the most liquid commodities currencies ever created. I've seen the ruble at 32 a year ago move 32 big figures in one day, in a round trip. I've seen the world's top 10 central bank, Russia, throw in the towel in December, and I've seen the number one central bank of the last 125 years, Switzerland, take out a revolver and put it in the back of their throat and blow their brains across the wall and ruin their credibility. I mean, these are major, major things that happen. I've seen the Great Britain join the Asian Chinese Central Bank and Pirelli being sold to Chinese. We're seeing some quite amazing things happen in a very, very short period of time. And, oil price moving 50%. There are some very, very exciting things. But one of the weirdest things is the Hindenburg omens. And
yes.
I have seen Hindenburg omens, for those of you who don't know what they are, is they are when you have lots of new highs and lots of new lows, and lots of stocks going up and lots of stocks going down on the same trading day, which means there's a lot of confusion. And Hindenburg omens have preceded every single stock market crash, but they don't necessarily mean that you will have a crash. So when we've had a crash, there's always been a previous Hindenburg omen, but Hindenburg omen is a 15 to 25% chance of a 10, 20% move. We had 6 in 8 days in December. We had, I think we had 14 in 22 days between December and January, and we've had some more in March. But even since then, in the last 30 days, we've seen the S&P move up and move down, move up and move down, move up and move down. And every day it's 1,800 stocks down, 1,500 stocks up, 1,800 up, 1,500 down. Sometimes, we're seeing a lot of new stocks hitting new lows. We're seeing a lot of stocks hitting new highs, which comes back to there is a lot of disruptive technology. There's a lot of currency moves. There's a lot of big winners from weak currency. India's been a big winner from low oil and a weak currency. People talk about the dollar, but the Chinese renminbi versus the ruble, Chinese renminbi against the euro, Chinese renminbi against the Indian rupee, massive moves over 2 years. So lots of winners and losers there, export or import. So lots of dislocation. I think a lot to do for active managers. And a lot of opportunities to make 200-300% returns.
Active managers last year, 87% of them didn't beat their benchmark.
But what is the benchmark? And I think this comes back to the problem. And this is where it comes back to what I've read about wealth management over the last 100 years. The benchmark is 60-40 bonds equity, or it might be 100% equity. But the number one flaw with all the wealth management books that have been published is they assume that in 1915, just to pick 100 years ago, you were smart enough to put all your assets into dollars, dollar equities and dollar bonds. Now, 9 out of 15 or 14 bond markets defaulted in the first 30 years of the last century for hyperinflation or bankruptcy, whatever, or Russia or China through hostile takeover, shall we say. And so you had to be smart enough. In 1915, you wouldn't have bought all your money in assets in America. In fact, in 1921, America had to go to Argentina to beg for money. And Argentina was seen as sophisticated individuals, and the Americans a bunch of schmucks. And look how that turned out, right? It didn't turn out so good. And in 1945, you said, well, I'm going to go into America rather than Germany or Japan. And look what happened in 1920. If I'd been in Germany and Japan, I would have lost everything. Well, between 1945 and now, the Japanese yen and the Deutschmark, went up, from 5 to 1 to parity sort of thing. So history tells you would have had to have been diversified across several bond markets, several equity markets, several currencies. And most of my clients are still dollarized or worse, euro-centric. You need to be diversified over history. We're at a point in time where China is likely to be number 1 or number 2 in your portfolio in 10 or 15 years' time by sheer economic weight. And virtually none of us have exposure. US is going down. That's not necessarily saying US is going to zero, but US is gone down from 25% of GDP. It's now 15, 16. It may be troughing, but it's been going down. Madam Merkel says it beautifully. She says 7, 25, 50. Europe is 7% of the world's population, 25% of the world's GDP. Both are falling, never likely to be ever gaining again, but we're 50% of the social welfare costs. So I keep saying to clients, diversify, not just because it's defensive, it avoids catastrophic error, but it also means you'll be able to buy the assets that you want in competition with everyone else. If you get it wrong, Swiss people can buy more Greek assets than American people can, because their currency's doubled over the last 10 years. Full stop. Didn't have to be particularly smart to do that. Just that. So diversification around the globe is important. Currency is important. We're seeing the Norwegian krona, Mexican peso at levels lower than 2009 when the oil was at 32 and the world was in chaos. These are Mexico particularly really restructured since 2009. Norway, certainly the smartest, one of the smartest sovereign wealth funds in the world, owns 1.5% of the world's stock markets. It's probably a better bet than the euro. You know, it's probably a better bet than the pound, which we don't even know who's going to be in power, if at all, in the next 6 months. So, you know, there's a lot of things we say to people, a lot of very interesting trades. I think that's the difference between last year. So active managers last year, yes, they underperformed. But the benchmark 60-40 equities bonds at zero rates doesn't have a lot more room, okay? And PE multiples are linked to inverse of interest rate multiples at the moment. So that trade is highly correlated. So active managers are going to have a good run sooner or later, just because the wall for passive is becoming, the hurdle for passive has become very, very hard, and volatility is low. So, but you have a choice. Passive, low fees, herd. Works most of the time, but it doesn't work when there's a big change. You pay an active manager to get that change. Now, if he doesn't get that change and he's there, he's no good. But that extra fee is to think out the box. Norwegian pension fund has changed from market-based weighting debt. It said to itself, we don't want to be with the people with the most debt. We actually don't want to be. We don't want to be passive. That's insane. We don't want to be the government's work. We want to be active. We're just giving people the problem with passive, you're giving it to the people with the most debt and the most problems already. You're giving it to the incumbents. We want to be with the resurgents, the innovators, you know. So the Norwegian pension fund's one of the few people who've got it. I think we've got it. We think that way. And you read anything about alpha generation, every single alpha generator that through history will have 1 in 3, 1 in 4 years of underperformance because they're contrarian at some point. Nobody's buying dry bulk shipping at this point in time. I'm an idiot, clearly. Right? There's no doubt about it. I'm an idiot. But I'm buying it because I think the risk reward is amazing. And that is not part of anyone's indices, and that's not part of anyone's portfolio. So, you know, I'm going to perform any passive manager. But I think I might make 3, 4, 5 times my money. So that's why I'm doing it. Stock markets could be down 40% next year. Dry shipping stocks could be up 100%. So, you know, you pay your money, takes your choice. But don't forget, you can have a little bit of active and a little bit of passive. You don't have to be 100% in either situation. And I would say to anybody, don't be 100% passive, because that clearly means at some point somebody will arb the system. There are already people arbing the ins and outs of indice replacements. You know, there's somebody making money somewhere. So that's what I kind of say to people. Find managers who've got information advantages or skill advantages. Warren Buffett, find a good manager with a great business model. Don't keep looking for great managers with bad business models. You know, a lot of macro, event-driven, convertible arb, a lot of long-short equity is everyone's got the information. There's no advantage anymore. So look for areas where people generally have advantages and generally can make money. You know, volatility is one area, distressed debt's another. There are areas where there are still information advantages that the public doesn't have. Not because it's not public, but because it's hard to get and dig it out. And one of the reasons why you know, I've liked, funny enough, I like uranium, of all things, is because I've seen direct buying in uranium stocks, you know, first time in 10 years. You know, really, we've seen direct buying in uranium stocks. Well, that's interesting.
Yeah.
You know, we've seen some direct buying in shipping, dry shop shipping levels, right? It's interesting. Directors putting money where their companies are is rare. We've still got a 10, 20 to 1 sales ratio of direct to buying and selling. So that's information we're using, a lot of people are not. We're looking at patent applications, patent filings for innovation, disruptive technology there. And we found, fun enough, this company that was recently bought for 21 billion was one of the stocks that we found that had a large number of patents in the largest growing sectors in the patent sector. It's all about probabilities and odds, and you start looking at it, risk reward is about that. That's one of the exciting things about coming to work every day.
Lee, we're going to have to wrap it up there.
Thank you.
Due to time constraints, you're an incredibly busy man. I really appreciate you finding the time to sit and talk to us.
Well, thank you. I love what you're doing with Real Vision. Good luck.
Perfect sign off. Lee, thanks very much.